Let me ask you something straight. Did you know that right now, in the 2025-26 financial year, a single retiree receiving the age pension can unknowingly trigger a reduction or even a complete suspension of their fortnightly payment by crossing a threshold that Centrelink updated quietly at the start of this year? A threshold that in real dollar terms sits just $4,000 above where it was 18 months ago. $4,000. That's not a dramatic windfall. That's a term deposit maturing, a small inheritance, a few extra shifts of casual work. And Centrelink does not send you a letter saying you're approaching the line. They wait, they recalculate, and then your payment drops, sometimes by hundreds of dollars a fortnight, while you're trying to figure out what went wrong. Here's the answer up front, because you deserve it quickly. The new income-free area for a single age pensioner in 2026 is $212 per fortnight. For couples combined, it's $372. Beyond those figures, your pension reduces by 50 cents for every dollar of additional income you receive. The cutoff point, where your age pension reduces to zero, sits at approximately $2,436 per fortnight for singles and $3,728 for couples. Those numbers moved. Most people don't know they moved, and the gap between not knowing and knowing is for tens of thousands of Australian seniors, costing them real money every single fortnight. Today, I'm going to break this down completely, not just the income test, but the asset test changes, the interaction with superannuation drawdowns that Services Australia counts in ways most retirees don't expect, the Commonwealth Seniors Health Card income thresholds that caught self-funded retirees off guard in early 2026, and the deeming rate situation that is still quietly affecting pensioners who have no idea it applies to them. Find your situation. Stay with me through this, because what's in this video could be worth thousands of dollars a year to you or someone you love. Before we go any further, if you're not subscribed to this channel, please do that right now and turn on the bell notification. Here's why that actually matters, and I'm not just saying it. Centrelink's rules, the income thresholds, the asset test limits, the deeming rates, the work bonus balances, these change multiple times a year. They change in January, in July, and sometimes outside those cycles entirely. Services Australia does not personally notify you when a threshold shifts. They update the policy, your payment recalculates, and unless you happen to know what changed, you're left confused about why your fortnightly amount looks different. What I do on this channel is track those changes, translate what they actually mean for your specific situation, and get that information in front of you before mistakes are made and before deadlines pass. Every section of today's video covers something that shifted in 2026 and is currently affecting real Australians right now. The people watching this channel find out in time. Subscribe, turn on the bell, let's get into it.
Let's start with the most common trap, the one catching people who are doing everything right, working a little, withdrawing from super, renting out a granny flat, but don't realise how Centrelink counts what they call income. The age pension income test applies to all forms of ordinary income, and the word ordinary is doing a lot of heavy lifting there, because Centrelink's definition is broader than most people realise. Wages from part-time or casual work? Yes, obviously. Net rental income from an investment property? Yes. Income from a private trust or a family company? Yes. Deemed income from your financial assets, including your superannuation account balance if you're over age pension age? Also yes, and this is where a lot of people get caught off guard. Here's how the income test actually works right now. As a single pensioner, you can receive up to $212 per fortnight before your age pension is affected at all. That's your income-free area. Once you exceed $212 per fortnight, your pension reduces by 50 cents for every additional dollar. It sounds gradual, and in some ways it is, but it compounds fast. Let's put a real number on it. Say you're a single pensioner receiving the maximum rate of $1,144.40 per fortnight in 2026. You've also got a small investment property that nets you $400 per fortnight in rent after expenses. Your income over the free area is $188. That's $400 minus $212. Centrelink reduces your pension by 50 cents for every one of those $188 over the limit. So your pension drops by $94 a fortnight. That's $2,444 a year you're losing, because of rental income your accountant might have told you is perfectly fine to have. It is fine to have, but it does reduce your pension, and that calculation is your responsibility to know about, not Centrelink's responsibility to explain to you each time.
Now for couples, the combined income-free area is $372 per fortnight. If you and your partner together bring in $700 a fortnight in combined income from all sources, you're $328 over the threshold. Your combined pension reduces by $164 per fortnight. That's over $4,200 a year. And here's what makes 2026 particularly important for this topic. The work bonus, which is a separate incentive that allows pensioners to earn additional employment income without affecting their pension, had its maximum balance carry-forward amount increased to $11,800 at the start of 2026. This is genuinely good news for people doing casual or part-time work, but it only applies to employment income and self-employment income. It does not apply to investment income, rental income, or deemed income from financial assets. And I speak to people regularly who think the work bonus covers everything. It doesn't. The trap is assuming protection where there is none. What should you actually do with this information? Log into your MyGov account, navigate to your Centrelink details, and check what income Centrelink currently has recorded for you. It should match what you've declared. If you've had any changes, a term deposit matured, you started a part-time role, your super fund changed its payment structure, you have 14 days to notify Centrelink. Miss that window and you may face a debt. Services Australia issued over $1.9 billion in welfare debts in 2024-25, and a significant portion of that came from income that wasn't reported in time. These aren't people being dishonest, they're people who didn't know the clock was running.
The asset test is where things get even more complicated, because unlike income, which fluctuates month to month and you have some awareness of, your assets can cross a Centrelink threshold without you doing anything at all. Markets go up, your super balance ticks over, and suddenly, in a quarterly review, Centrelink adjusts your payment. Here are the current asset test thresholds for 2026. For a single homeowner, the full age pension starts to be affected at assets above $314,000. For a single non-homeowner, that figure is $566,000. For a couple who both own their home, the combined limit before reduction begins is $470,000. For a couple who don't own their home, $722,000. Now let's talk about what counts. Your home does not count. The family home is exempt from the asset test regardless of its value, but almost everything else does. Superannuation balances, once you've reached pension age, count in full. Investment properties count at market value, not purchase price. Bank accounts, term deposits, shares, managed funds, even a caravan or a boat above a certain value. And here's one many people genuinely don't know. If you have a life insurance policy with a surrender value, Centrelink counts that surrender value as an asset. The pension reduces under the asset test at $3 per fortnight for every $1,000 of assets over the lower limit. So for a single homeowner with $450,000 in assessable assets, you're $136,000 over the lower threshold. Your pension reduces by $408 per fortnight. That's a reduction of $10,608 a year. And if your super fund had a strong quarter and your balance grew, that number could shift without you lifting a finger. What changed in 2026 specifically? The thresholds themselves were indexed in January. They moved up slightly, approximately $8,750 for singles and $13,500 for couples, compared to the July 2025 figures. This is normally good news because it means more Australians can have higher asset balances without losing pension entitlement. But the indexation created a false sense of security for a group of self-funded retirees who fall just above the full pension cutoff, approximately 47,000 people according to Services Australia data, who re-examined their entitlements after the January update, made new financial decisions based on new projections, and then found themselves back over the threshold when their superannuation accounts were revalued in March. The lesson here is painful but simple. Asset test thresholds change, but your asset values change more. Especially in an environment where superannuation funds are still generating returns, you cannot assume your Centrelink eligibility is fixed just because you checked it 6 months ago. If you're anywhere near the asset test threshold, within $50,000 either direction, it is worth speaking to a financial advisor who understands Centrelink assessment rules specifically. Not all financial advisors do. Ask them directly, are you familiar with the deeming rules and how Centrelink assesses superannuation in the asset test? Their answer will tell you what you need to know. One more thing on assets that almost nobody talks about: gifting. If you give money or assets to your children or grandchildren, and many retired Australians do, Centrelink has strict rules about how much you can gift before it still counts against you. The current gifting limit is $10,000 per financial year and $30,000 over any rolling 5-year period. Give more than that, and Centrelink continues to count the excess as though you still own it for 5 years. It's called deprivation, and it means that being generous to your family can actually cost you in pension entitlements if you're not aware of the rules first.
This section is important because deeming is probably the least understood part of the Centrelink system, and it directly affects your pension calculation in ways that have nothing to do with what your money is actually earning. Deeming is how Centrelink estimates the income from your financial assets. Rather than asking you to report the actual interest or dividend or return you receive each month, Services Australia applies a fixed assumed rate of return to your financial assets and uses that as your income for pension purposes. Whether your term deposit is earning 4.8% or 2.1%, Centrelink calculates what you're supposedly earning based on its own deeming rates. Right now, in 2026, the deeming rates are, for a single pensioner, 0.25% on the first $62,600 of financial assets and 2.25% on everything above that. For a couple, 0.25% on the first $103,800 combined and 2.25% on everything above that. These rates were set during a period of suppressed interest rates and have not fully caught up with where actual savings rates have moved. But here's the issue going in the other direction. Many pensioners are receiving returns on their bank accounts and term deposits that are higher than 2.25%. In a 2026 environment where some online savings accounts are offering 4.5% and some term deposits are paying above 5%, a pensioner with $200,000 in financial assets could be receiving $9,000 or $10,000 a year in actual interest, but Centrelink only deems them to be earning approximately $3,100 per year on that same balance. In that scenario, deeming is actually protecting their pension rather than hurting it. But there's a flip side, and it catches people who have their money in lower-yielding accounts or who have recently moved funds around. If Centrelink deems your financial assets to be producing income at 2.25%, but your actual return is lower because you moved to a capital-protected structure or a more conservative investment, your deemed income for pension purposes could be higher than your real income. You pay the pension reduction penalty based on a figure that doesn't reflect reality. This becomes especially significant for people who have recently moved money out of superannuation into a bank account, or who inherited funds and left them sitting in a low-interest account while they figured out what to do with them. Centrelink doesn't care what the money is doing. It deems it earning at the published rate regardless. Think about what that means practically. Margaret is a 70-year-old widow in regional Victoria. Her husband passed away 18 months ago and she received $280,000 from his estate. She put it in a savings account at her local bank, earning 1.8% while she decided what to do. On that $280,000, Centrelink is deeming her to earn 2.25% above the $62,600 threshold, approximately $4,910 per year in deemed income. Her actual interest is closer to $3,400. She's being assessed on $1,500 more income than she's actually receiving, and her age pension is being reduced accordingly. She doesn't know. Nobody told her. If you have financial assets between $100,000 and $400,000, it's worth understanding exactly what Centrelink is deeming your income to be and comparing that to your actual returns. Services Australia's online estimators can help, or you can call them directly on 132 300 and ask to have your deemed income calculation explained to you. Don't assume it's correct without checking.
If you're a self-funded retiree who doesn't qualify for the age pension, perhaps because your superannuation balance or other assets put you above the pension thresholds, this section is specifically for you. The Commonwealth Seniors Health Card is one of the most overlooked entitlements in Australia for people in your position. It gives you access to cheaper prescription medicines under the PBS, bulk billed GP visits at many practices, and a range of state and local council concessions depending on where you live. The combined value of these concessions for a couple can easily reach $2,500 to $3,000 or more per year, in some states considerably more when you factor in vehicle registration discounts, council rate rebates, and utilities assistance. And the income threshold for this card moved in 2026. The adjusted taxable income limit is now $99,025 for singles and $158,440 for couples combined. Those figures were indexed up from the previous year, meaning some self-funded retirees who checked their eligibility in 2024 and found they were over the threshold may now be under it. This is not a trivial point. If your income sits between $92,000 and $99,025 as a single retiree, you may have become newly eligible in 2026 without realizing it. What counts as income for this card? Your adjusted taxable income, which includes your taxable income, total net investment losses, reportable employer superannuation contributions, and deemed income from account-based superannuation pensions. That last one is critical. The card doesn't assess your actual super withdrawals as income in the traditional sense. It applies deeming to your account-based pension balance and counts that deemed amount. This is where the structure of your retirement income really matters. For singles especially, there is a real middle ground, people with superannuation balances between $500,000 and $900,000 who may qualify for the Commonwealth Seniors Health Card but have never applied because they assumed their super made them ineligible. The assumption is wrong for many of them. The card is means tested on income, not solely on assets. If your super is drawing down gradually and your deemed income stays under $99,025, you may well qualify.
There's also something called the senior supplement that was historically attached to similar cards, and while the direct cash supplement has changed over the years, holders of the Commonwealth Seniors Health Card can still access the energy supplement, currently $14.10 per fortnight for singles. It's a modest amount, but when you're talking about a card that costs you nothing to hold, every benefit on top of the PBS savings matters. Apply online through MyGov under the Services Australia tab or call 132 300 and ask specifically about the Commonwealth Seniors Health Card. Bring your most recent tax return details and your super fund's current balance. The application is straightforward, and if approved, the card takes effect promptly. If you've been eligible for this card and haven't had it, the back payments on PBS savings alone over a year or two could be substantial.
This final major section connects everything we've covered, and it's where I see the most expensive mistakes being made by Australians who are otherwise doing the right thing financially. Once you reach pension age, currently 67 for both men and women in Australia, your superannuation account balance is assessed under the assets test, and if you have an account-based pension, which is the most common structure for Australians drawing down super in retirement, Centrelink also deems that balance to be producing income under the income test. So your superannuation simultaneously affects both tests. It's one pool of money, but it's counted twice. Now, here's the strategy consideration most people don't know about, and I want to be very clear that this needs to be discussed with a qualified financial advisor before you act on anything, but it's worth understanding the dynamic. The rate at which you draw down your superannuation matters, not just for your retirement balance, but for your Centrelink entitlements. Centrelink assesses your account-based pension balance and applies the deeming rate to it as though it's producing income at that rate. But your actual pension payments from super are not counted separately as income on top of the deemed amount. So the income Centrelink sees from your super is the deemed amount only, not the withdrawals you're actually taking. This means that drawing down your super balance, even just spending it on legitimate living expenses, a home renovation, dental work, or prepaying funeral costs through a compliant funeral bond, reduces the balance that gets deemed, which can reduce your assessed income for Centrelink purposes, which can increase your age pension payment. In some cases, the pension increase is significant enough to partly offset the reduction in super balance. The numbers vary greatly depending on your individual situation, but for someone with $400,000 in account-based super drawing the minimum pension rate, a reduction of that balance to $300,000 through strategic drawdown could result in a pension increase of $45 to $60 per fortnight. That's $1,170 to $1,560 per year in additional pension income, money you'd receive every fortnight without doing anything further. The mistake people make is the opposite, leaving their super to accumulate and compound because they've been told, let it grow as long as possible, without realising that that growth is simultaneously increasing their assessed income and assets under Centrelink rules and reducing their pension entitlements year by year. And there's an important Centrelink rule many people don't realise protects them in this situation. A prepaid funeral bond up to $15,000 is fully exempt from the assets test. So is the value of a funeral plan with a funeral director. These are legitimate, practical expenses that reduce your assessable assets and a sensible end-of-life planning at the same time. Using funds in this way isn't a trick, it's using the exemptions the government deliberately built into the system. There are also granny flat arrangements where you transfer assets to a family member in exchange for accommodation and care that have specific Centrelink assessment rules. These can be appropriate in some situations and damaging in others, entirely depending on how they're structured. If anyone in your family has suggested a granny flat arrangement as a way to reduce your assessable assets, please speak to a social worker or financial advisor through Services Australia before agreeing to anything. The rules are complex and the errors are irreversible. The overarching message here is that the way you hold, draw down and spend your retirement assets does not happen in a Centrelink vacuum. Every financial decision you make in retirement touches your pension entitlements in some way. Knowing how is not optional. It's the difference between leaving money on the table every fortnight and receiving what you're actually entitled to.
Let's bring everything together because there's a lot to carry out of this video. If you're currently receiving the age pension, go into MyGov today and check what income and assets Centrelink has recorded against your name. Compare it to reality. If anything has changed, a term deposit, a casual income shift, a new super arrangement, notify Services Australia within 14 days to avoid a debt. If you're a self-funded retiree who hasn't looked at the Commonwealth Seniors Health Card since before 2026, look again. The adjusted taxable income threshold is now $99,025 for singles and $158,440 for couples. You may be newly eligible for a card worth thousands of dollars a year in concessions. If you have financial assets, bank accounts, managed funds, shares, and you're receiving the age pension, understand what Centrelink is deeming your income to be and compare it to what you're actually earning. Call Services Australia on 132 300 and ask them to walk you through your calculation. Don't assume it's right without checking. If you have superannuation in an account-based pension and you're over age pension age, understand that your balance is affecting both the income test and the asset test simultaneously. Talk to a financial advisor about whether your current drawdown rate is optimized for your pension entitlements, not just for your super balance projection. And if you've gifted money to family members recently and it exceeded $10,000 in the financial year or $30,000 over 5 years, be aware that Centrelink may still be counting the excess as your asset for up to 5 years. Check your record. The rules in this video are current as of mid-2026. They will change. Deeming rates, asset thresholds, income-free areas, Services Australia reviews these regularly, and when they change, no one is going to call you. That's why being subscribed to this channel matters. When things shift, I break it down in plain language, specifically for you. If this video helped you understand something you didn't know before, or if it made you realize there's something you need to check, please share it. Forward it to a family member. Send it to a friend who's approaching retirement. The people who need this information most are often the ones who don't know to look for it. Subscribe, share this with someone who needs to hear it, and I'll see you in the next one.